Welcome to the Deep Dive. Today, we are diving deep into a stock that, well, really captures the wild ride of this AI boom. Applied Digital Corporation, ticker APLD. And if you're looking at the market today, APLD is absolutely flying. The stock indicated up over 20%, pushing towards, what, $33.80 a share?
That's right, and it's on the back of this huge news, almost $11 billion in potential contracts announced.
Which, I mean, that number just screams AI winner, doesn't it?
It really does. But here's the tension, the paradox we need to sort of unpack today.
Exactly. Because despite that massive number, APLD is still deeply unprofitable. It's burning through cash like crazy.
And at the same time is one of the most heavily shorted stocks out there, a real battleground.
So that's our mission, right? We've got the financials, analyst reports, risk assessments, all current as of October 10th, 2025.
Yep. And we need to figure out if Applied Digital is genuinely the ground floor of a future AI infrastructure giant, or if this current stock price is, maybe a speculative bubble pricing in way too much too soon.
Huge gap between those two possibilities. Okay, before we dig into the money side, let's start with the business itself. What do they actually do?
Okay, yeah, let's get into it.
So first off, you got to understand the huge shift this company made. They weren't always about AI.
Not at all. They started as Applied Blockchain, deep in the crypto mining world.
Right, crypto. But then they pivoted hard.
Saw the writing on the wall, probably, and repositioned themselves completely as an enabler for the AI boom. Now they design, build, and operate these specialized data centers.
High-performance computing, HPC data centers, they call them AI factories, which is quite the marketing term.
It is, and that pivot really defines their whole story now. The core business is this HPC hosting.
And how does that work? Is it like renting server space?
Sort of, but much bigger scale and longer term. We're talking massive lease agreements, typically 15 years, sometimes even longer.
15 years, wow.
Yeah, with these huge hyperscale customers, the giants driving the AI demand.
Okay, but let's look at the revenue they're actually bringing in now, because that's where it gets a bit tricky, right?
Extremely tricky. You need to look very closely. So recent quarterly revenue was, what, $64.2 million?
Okay, sounds decent.
But wait, a big chunk of that, $26.3 million, was from what they call tenant fit-out services.
Fit-out services, what's that?
It's basically a one-time construction fee. It's not the recurring lease income that everyone's excited about for the future.
Ah, so it makes the current revenue look bigger than the actual stable ongoing part.
Exactly. That non-recurring chunk inflates the top line right now and kind of hides how small the actual recurring lease revenue is today.
Yeah.
That's critical to understand.
Got it. So nearly a third of that $64 million was just a one-off. Okay, let's talk about the facilities themselves. These aren't just regular data centers, are they?
No, definitely not. They're custom-built, ground up for AI workloads, very specialized.
What makes them special?
Density, mainly. Power density. They're designed to handle over 50 kilowatts per rack.
50 kilowatts, that sounds like a lot.
It's extreme. Less than 10% of data centers globally can handle that kind of power draw per rack. It needs advanced cooling, too, like direct-to-chip liquid cooling.
Okay, so they build these specialized high-power facilities.
Oh.
Why would a huge hyperscaler go with APLD instead of, say, a giant like Equinix? What's the pitch?
It boils down to three things, really. Speed, specialization, and cost efficiency. Especially cost.
How are they cheaper?
Location, location, location. They build these AI factories in places like North Dakota.
North Dakota. Why there?
Cheap power, number one. And number two, the climate allows for what they call free cooling for a big chunk of the year, over 200 days.
Free cooling, meaning they just use the cold outside air.
Pretty much. Instead of running power-hungry chillers all the time, it massively cuts down operating expenses.
And that translates to real savings for the customer.
Huge savings. The company claims they can save a big 100-megawatt client something like $2.7 billion over 30 years compared to traditional setups.
$2.7 billion. That's a massive advantage if true.
It's a game changer, potentially. And that cost advantage plus the specialization creates their competitive moat, or at least that's the idea.
What stops someone else copying this?
Well, the barriers are pretty high. First, capital. You need billions. That $5 billion financing capacity they have with Macquarie, that tells you the scale.
Right, $5 billion is serious money.
And maybe even more critical is getting access to power. You need huge amounts of electricity locked down before you build. Power is the bottleneck these days.
Okay, and once a customer is in, with all their expensive gear.
They're basically locked in. Those 15-year contracts, the bespoke setup for their specific chips,
Yeah.
the switching costs are monumental. It's very sticky.
Okay, so a capital-intensive model. That means the management team running the show is crucial. Who are they?
The CEO is Wes Cummins. His background is in technology investing, which kind of informs their whole strategy, you feel.
And you mentioned that pivot from crypto to AI. That seems like the big strategic win for this leadership team so far, right?
Yeah.
Navigating that crisis.
Absolutely. It showed strategic foresight, or at least adaptability. And that investor mindset really shapes how they allocate capital.
How so?
It's all about aggressive organic growth. Building new stuff from the ground up, greenfield development. They're not looking to buy existing facilities.
And funding that growth. You mentioned Macquarie.
Yeah, that deal is key. Up to $5 billion in perpetual preferred equity.
Perpetual preferred equity.
Yeah.
What does that mean for regular shareholders?
Well, the structure is designed specifically to minimize dilution for the common stockholders. It's a way to get massive funding without selling off tons of new common shares, which would hurt the stock price. Pretty sophisticated move for a company this size.
Okay, sophisticated financing. But if we look at how well they're using the capital right now, the numbers look, well, not great. Return on invested capital, ROIC.
Yeah, it's deeply negative, around minus 17.81%.
Minus 17%. Doesn't that just scream they're destroying value with the money they're spending?
Logically, you'd think so, and that's the immediate reaction, right? But here, in this specific case, a negative ROIC is actually expected. It's built into the model at this stage.
How can negative returns be expected?
Because they've deployed billions into assets, concrete, steel, power infrastructure that aren't generating revenue yet. They're construction sites, basically.
Ah, okay. So the capital is invested, but the returns haven't kicked in because the factories aren't running yet.
Exactly. Investors are underwriting this negative number now based on the expectation of a huge swing to positive high-margin returns later once those facilities are operational and churning out lease income. You're paying today for tomorrow's hoped-for profits.
Right. Paying for the future. Let's look at the actual numbers underpinning that bet. Revenue growth first. That looks pretty explosive, doesn't it?
Undeniably. They went from basically zero in fiscal 21 to $144.2 million in fiscal 25. That's rapid scaling of capacity. Very fast.
But scaling costs money. A lot of money, it seems. Let's talk costs and profitability, or lack thereof.
Yeah, this is where the bear case really bites. Margins are terrible. The trailing 12-month net profit margin is negative 108.4%.
Minus 108%.
Right.
So for every dollar of revenue, they're losing more than a dollar.
That's what it means, yes. The losses are massive, outpacing revenue significantly.
Why so high?
Operating expenses are soaring. SG&A, selling, general, and administrative costs jumped 165% year over year.
What's driving that?
Part of it is stock-based compensation for executives, about $16.6 million recently. Plus, they're taking on debt to build, so interest expenses are climbing fast too.
Okay, high costs, big losses. What about cash flow? Free cash flow, FCF.
Brutal. Just brutal. One recent quarter showed negative FCF of $191.4 million.
Burning almost $200 million in 3 months.
Yeah. It's not just tight on cash, it's a cash furnace. This confirms they are completely dependent on constantly bringing in external money, that Macquarie funding, maybe new debt, maybe selling more stock just to keep the lights on and the construction going.
That sounds precarious. Does that show up in their stability metrics?
It absolutely does. Two key ones raise red flags. First, debt to equity. It's high at 1.11.
Meaning more debt than equity funding the company.
Correct. But the more immediate concern is the current ratio. That's a measure of short-term liquidity. Can they pay their bills coming due soon?
And what is it?
It's low, 0.77.
Below 1.0. Can you spell out what 0.77 really means in practical terms?
Sure, a current ratio below 1.0 means they don't have enough current assets, cash, receivables, things easily converted to cash to cover their current liabilities, bills due within about a year.
So 0.77 means?
It means right now they only have enough liquid assets to cover about 77 cents of every dollar of their short-term obligations. They're short. They need that external financing to come in quickly just to meet their immediate bills. Confirms that dependence we talked about.
Wow, okay. High debt, low immediate liquidity. Now valuation. Earnings are negative, so PE is useless. You have to look at price to sales, PS.
Right, and this is where you really see the market's massive expectations priced in. APLD's forward PS ratio is 14.46x.
14.46. How does that compare?
It's incredibly high. The industry average PS is around 3.58x.
So more than 4 times the average.
Yes, and it's double the ratio of established profitable data center players like Equinix.
So that 14.46x number isn't just pricing in growth.
No, it's pricing in perfection, flawless execution, massive market share gains, everything going right, starting basically now, maximum optimism.
Okay, that's a very high bar. Before we get into how the market feels about that valuation, let's take a quick moment. Just a reminder, folks, like and subscribe to Stock Analytics AI. For just $4.99 a month, that's about $4.99 USU, you unlock our full playlist. That's 500 deep dive videos covering every single stock in the S&P 500.
And coming up next, exclusively for members, we are tackling the NASDAQ 100. Big tech, growth stories, we'll cover them all.
Plus, members, remember you can request deep dives. Just drop the ticker symbol in the comments on any video and we'll add it to our list. Okay, back to APLD. All right, we're back talking about APLD, the ultimate battleground stock. Despite those financials we just discussed, the cash burn, the negative margins, Wall Street seems to love it.
Incredibly bullish, many of them. The analyst consensus rating is actually a strong buy.
Strong buy. And price targets.
Some are soaring, especially after that recent contract news. We're seeing targets as high as $43 per share now.
$43. Compared to the $34 it's near now, that implies significant upside still.
Yeah, the momentum players are definitely interested. Technically, the stock chart shows a strong bullish trend. It's trading way above its 200-day moving average, over 150% above it.
There's always a but with this stock.
Yeah.
That bullishness is met with extreme skepticism from others.
Deep, entrenched skepticism. And you see it clearly in the short interest figures.
How high is it?
Exceptionally high. Depending on the source and calculation, it's somewhere between 26.04% and 29.83% of the publicly traded float.
Wow, over a quarter of the available shares are being shorted. That's a massive bet against the company.
It's huge. It means a significant amount of capital is wagering that this whole growth story is going to fall apart, or at least that the stock is wildly overvalued.
And that huge short interest creates its own dynamic, doesn't it? The short squeeze potential.
Exactly. If the price keeps climbing, especially on more positive news, those shorts start losing a lot of money. They might be forced to buy back shares to close their positions covering their shorts.
And that buying pressure just drives the price even higher.
Precisely. It's the classic short squeeze setup. That potential is definitely part of the APLD story right now.
Okay, so a tug of war between bulls and bears. Who actually owns the stock? Who holds the power here?
Well, looking at the big picture, institutional confidence seems pretty solid.
Meaning the big money managers.
Yeah, pension funds, mutual funds, ETFs. Firms like BlackRock and Vanguard hold significant stakes. Overall institutional ownership is quite high, between 52% and 58%.
So more than half the company is owned by these large institutions. That's usually seen as a positive sign, right?
Yeah.
Stability, long-term belief.
Generally, yes. It provides a counterweight to that high short interest, but there's another ownership detail that raises eyebrows, and it's a key point for anyone scrutinizing the company.
Okay, what is it?
It's the pattern of net insider selling. Consistently.
Insiders. Meaning the executives, the board members.
Exactly. Now, insiders still own a good chunk of the stock, somewhere between 20–23%, which aligns their interests with shareholders generally. That's positive.
But they're selling more than they're buying.
Significantly more. Based on public filings over the past year, we're talking top executives, the CEO, the CFO, they've been net sellers.
Huh. That does seem contradictory, doesn't it? If you truly believe you're building the next AI giant with $11 billion in potential contracts.
You'd probably be buying more stock, or at least holding on tight, right?
Yeah. So consistent insider selling. That's a data point you absolutely have to weigh against the optimistic narrative from the company and the bulls.
Yes.
It's a signal you can't just ignore.
Definitely something to keep in mind.
All right, let's pivot specifically to the risks. We've touched on some, but let's use the SWOT framework. Strengths, weaknesses, opportunities, threats. Given the potential reward here, the risks must be equally significant.
Absolutely. Let's focus on the weaknesses and threats. One huge internal weakness highlighted in our sources is extreme customer concentration.
We talked about the long-term leases with hyperscalers, but it sounds like it's really just one hyperscaler driving things right now.
That's the core issue. That entire projected revenue stream, that nearly $11 billion figure getting headlines, it's apparently all tied to a single partner, CoreWeave.
One customer for the whole $11 billion pipeline.
That seems to be the situation based on the available information, which makes it an existential risk.
How so?
Well, think about it. If anything goes wrong with CoreWeave, they're funding their strategy, their demand. APLD's entire business model is immediately in jeopardy. It's a massive single point of failure.
That definitely undercuts the idea of a wide competitive moat, doesn't it? If you're entirely dependent on one customer.
It certainly shifts the power dynamic. CoreWeave must have immense negotiating leverage over APLD on future pricing and terms. It feels less like market dominance and more like a very deep but potentially fragile partnership.
Okay, so customer concentration is a major weakness. What about external threats? Things outside their control?
Two big ones stand out. First, macro risk. We already talked about their high debt load and reliance on financing.
Right, so interest rates are a huge factor.
Exactly. If interest rates keep rising or even just stay high, the cost of borrowing money to build those next huge data centers goes up significantly. That could slow down their growth plans or make future projects much less profitable. They're very sensitive to Fed policy.
Makes sense. What's the second external threat?
Geopolitical risk,
Yeah.
specifically trade tensions and tariffs. Our sources flag the impact of potential U.S. tariffs in 2025, targeting tech components coming from Asia.
Like chips and server parts. From where?
Yeah, places like China, maybe a 34% tariff mentioned, Taiwan, 32%. These are critical components for the servers APLD needs to install.
And what would those tariffs do to APLD?
Two really bad things for a company like this. First, it directly jacks up their capital expenditures. The servers and GPUs just get more expensive, which hurts project economics and margins.
Okay, higher costs. What's the second thing?
Delays, supply chain chaos. If getting specialized components gets held up for months because of tariffs or trade friction,
It completely wrecks their speed to market advantage.
precisely. That speed is supposedly one of their key selling points. Delays are poison.
And delays link back to profitability too, right? Because they're burning cash until those facilities start generating revenue.
Exactly. Every month of delay means more cash burn, more negative ROIC, more pressure on financing. It adds huge execution risk to their timeline, which is already aggressive. The valuation demands smooth, on-time delivery. Tariffs are a major threat to that.
Okay, we have covered a lot of ground here. Let's try to synthesize this. The core bull case for APLD. What is it in a nutshell?
It's basically pure play AI infrastructure exposure, massive revenue visibility with that potential $11 billion backlog, smart financing minimizing dilution, and potential cost advantages from location and design.
And the core bear case.
Highly speculative bet, burning cash rapidly, dangerously dependent on a single customer, high debt levels in a rising rate environment, huge execution risk to actually build everything on time and on budget, plus that nagging insider selling.
That's quite the contrast. So we ran our educational discounted cash flow or DCF model. Since earnings are negative, you have to project future cash flows. What did the model suggest for intrinsic value?
Based on our analysis and assumptions, the educational DCF model points to an intrinsic value range of somewhere between $18 and $26 per share.
$18 to $26. Okay, now compare that to the current market price.
Well, with the stock indicated near $34 today, it's trading at a significant premium, even to the high end of our estimated range.
So what does that premium imply? What is the market pricing in at $34?
It implies near perfection. Investors at this price aren't just betting on APLD successfully building out that 400 Middle W campus for CoreWeave without a hitch.
They're betting on more.
Oh, yeah. They're pricing in the immediate, successful signing and flawless execution of the entire rest of the company's multi-gigawatt future pipeline. No delays from tariffs, no funding issues from higher rates, no cost overruns. It's a price that demands everything goes right.
That is a very high bar for a company still burning cash. Which leads us to our final thought for you, the listener, to chew on.
Considering everything we've discussed, the geopolitical risks, like those potential tariffs messing with supply chains, and the macroeconomic risks, like rising interest rates making borrowing more expensive.
Which of those two big external threats, geopolitical delays or rising interest rates, do you think poses the greater, more immediate danger to APLD actually hitting its profitability targets and justifying this current valuation? Something to mull over.
And as always, please remember this important disclaimer. This analysis was generated by an AI system. It's for educational and informational purposes only. It is absolutely not financial advice.
Please, do your own research, dig into the filings yourself, or consult with a qualified financial advisor before making any investment decisions based on this discussion.
Definitely. Your capital is your responsibility.
One last reminder. For just $499 a month, you get those 500 S&P deep dives, plus our upcoming NASDAQ 100 coverage, and the ability to request specific stocks. Check out Stock Analytics AI. Thanks for tuning in to the deep dive. We'll catch you on the next one.